that, but
Okay,
okay.
so yeah, Nick, go ahead and introduce yourself maybe and just give us some good information for us today.
Yeah, so quick, I guess, bio. Born and raised in Victoria. I'm an old man compared to all you. 44 next week, and
That's nothing.
oh hey, I'm quite immature, so that's fine. And I've been in the mortgage business since 2004, and done real estate sales since around 2012. So I guess 10 years there. And yeah, I've just always loved every part of the real estate business, from the renovation, construction, finance, sales, all of it. And so, yeah, the industry is a perfect fit for me. And I take a lot of pride in trying to help people understand and be informed about what their options are with financing, and just steer them correctly through the always murky waters. The one thing that's always the same in mortgage financing is change. It's the government can come in at any time and impose regulatory
You don't
changes.
say.
Yeah, absolutely. And believe it or not, they often don't do it necessarily with the greatest of foresight and plan. So it's a challenge to keep on top of it, but we take pride in it, and having a good network that can help you provide better service for your clients will make you more efficient and more profitable, which is what we're looking to do. What I wanted to talk about today as a kind of first thing is the part of, I'm just trying to do a screen share here, the part of real estate sales where you guys really need to pay attention to the types of properties that your clients ask to see. I don't want you guys to be tour guides. You don't make any money driving around and just showing people places for the fun of it. So what I've got here is, and I'm going to go through it fairly quickly. I'm happy to send it to people afterwards if they would like a copy, but 25 different types of things that can come up with a property that you guys really should be aware of if someone, you know, flags it and wants to see it, so that you don't waste your time if they're not going to be able to get money to buy it, or at least gives you the opportunity to have that conversation with your people before you go. And if nothing else, it will make it look like you're you know, very knowledgeable by directing them to the potential concerns. So I'm going to flip through these pretty quickly. First one, Orchard House down in James Bay. The challenge with this, you look at the MLS and it's a, you know, nice looking condo, price seems fantastic. Well, the concern with it is this. Oh, sorry. Why can I not index through my slide? There. The title. With Orchard House, you don't actually own, the strata does not own the land upon which it sits. So you are not able to secure a mortgage against it in the same way that you would with pretty much any other strata property. So anytime you see leasehold as the title, definitely do your homework before you go and show it. And they're always cheap, and people always want to see them because they don't understand it.
They're great lead generators for listings.
Yeah, exactly. For people with zero budget.
Correct.
Second property type. These don't come up all that often, but they do come up, and there are some nice buildings that are with title this way. Rather than being freehold strata or leasehold, they're what's called a co-op. And it was an ownership structure that predates the Strata Property Act, where basically a company owns the entire building, and then the unit owner is going to share in that company, which gives them the right to use that unit to live in. You can't get a mortgage against a share typically in the bylaws of these co-op corporations. So really, you know, co-ops, there's some nice ones. Here's a nice almost waterfront one in South Oak Bay, but very, very, very difficult, if not impossible, to finance. Another one, this is a native leasehold on the Peninsula. There's a number of properties out there now that are with this kind of ownership structure. And there have been issues that lenders have had where the band who administers or owns the land that the thing sits on there's been dispute about who has the legal right within the band to even sign agreements allowing for the mortgages against these things. So a lot of lenders just hard stop. We won't even look at it. It's just too much trouble. Not worth trying to figure out.
How many years out is a safe amount of years for a lease renewal?
Well, here, this one I've circled 2040.
That's not very far away, you
The
know?
clock seems to be going faster and faster every year in my life.
Yeah.
Typically at the very least, 5 years longer than the mortgage amortization. Like the lender will want all their money back at least 5 years before the thing is over. So if you're looking at 2035, maybe if a lender would touch this, they might give you a 13-year, 12-year mortgage as we're coming up to the end of 2022.
Okay.
And Nick, does the band own the structure after the lease has expired, like the 2040?
I am not an expert on First Nations leasehold properties because whenever anyone wants to buy one, I tell them don't.
Ha.
But I believe, and Jeff, jump in if you have a different opinion. I believe that you would still own the structure, you just wouldn't have the right to keep it there anymore. So
Yeah, you own the structure, but basically you would have a period of time to have it craned out of there essentially.
yeah,
Because that's what you are buying is the structure and the right to that rent pad, right?
yeah, exactly.
So I've had clients in the past that have had mobile parks that were getting closed down, and they bought these mobiles that were kind of run down for $20,000, and then we're having them craned to another lease land that had like 90 years left, and we paid 15 grand to crane it. So we were into this mobile for less than 40. They did a $10,000 reno and then sold it for about 200,000. So where it sits is really where the value is. The mobile themselves don't really have a ton of value, right?
And that's an interesting one. Flipping mobiles for fun and profit. I like it.
You know what? If you're just like a random construction guy, it's a great little side job for renovators and
As long as you can find a place to put it.
that's the main thing, yeah.
Here's an interesting one. These come up from time to time and they look spectacular. Piers Island. It's a very small island, 5 minutes from the Swartz Bay Ferry Terminal. Most lenders won't touch the place because there's no BC ferry to get there. You've got to get there by private boat or water taxi. And that limited access, lenders view it as restricting the marketability, even though they're extremely desirable. Almost every house, I think, other than 3 on the island are waterfront. But yeah, they're very, very hard to mortgage. Here's a classic Victoria, late 40s, early 50s bungalow. Looks fine, bit tired maybe. Issue with this one, it was a grow up. And even if the building has been remediated, even if they've got new occupancy permits and environmental paperwork, some lenders just don't want to touch that. It's more trouble than it's worth for them. Why take the risk? There's other opportunities. So,
And that runs with the land, right? So you get it remediated, signed off, you forever need to disclose that it had been a grow up at some point, right?
yeah, absolutely.
Yeah, so I've had clients that are like, oh, that's fine, I'll just remediate it and like I'm gonna flip this thing because they're usually a bit of a deal, but then you got to give that discount when you sell it too, right?
Exactly. Property on Linden, nice looking condo, age restricted. So in Canada, most people are familiar with Canada Mortgage and Housing Corporation, CMHC. They're a federal Crown Corp. So if you're getting a mortgage that's insured through CMHC, because it's federally run, they're extraordinarily sensitive about any form of discrimination. And age discrimination is one of those things. So anyone who's looking to do anything through CMHC, the building cannot have any age restriction whatsoever. There are 2 private sector insurance companies that provide alternatives to CMHC, same kind of coverage, that just are not with the same anti-discrimination rules, but age restrictions, just watch out. Arnold, this was a lovely house. Part of it was heritage designated. And you might think it on the surface, wow, heritage designation, it's nice, it's special, everyone would like that. Lenders set all of their policies sitting in a law office in Toronto for the most part, and they don't like anything that's weird. And they view this as being something that could actually reduce the fire pool. So a lot of the times lenders just, sorry, it's heritage, not interested. Property in Saanich. This one has a 4,000 square foot equestrian center. Lenders like to lend against a house and the land that it sits upon. They do not want horse stuff, huge outbuildings, barns, anything that's beyond the sort of main house. If you see a property with lots of outbuildings or where a substantial amount of the value is coming from other stuff, often lenders will still finance it, but they will ignore the contributory value of some of those site improvements. They'll say, well, that barn's worth $800,000. You paid 3, we're going to only lend it on 2.2. And
Nick, is it true that a lot of lenders will look at the main house and maybe like one outbuilding, and then they kind of will ignore the remaining ones?
it depends what the outbuilding is. Like a detached garage, sure, no problem. And they're getting better with garden suites, which don't exist in most of Canada, but are starting to have enough of an impact that lenders are adopting policies to reflect them. If it was like an art studio or like an accessory building that's basically kind of normal, that's fine.
It's a good thing we don't have a housing shortage, Nick, because
no, exactly.
Right.
Exactly. This one, just it's raw land. Raw land, the mortgages are very, very, very much different than something with a house on it. Typically, you're going to cap out at 75% financing if you're lucky, 65 to 75%. The rates are more expensive. So anytime someone's looking for land, just make sure they've got their ducks in a row. This is a weird one, comes up rarely, but it can be a very hard one to sort out. It is a larger, so the particular strata has 40 units, and it's self-managed. And lenders have been burned across the country by self-managed strata corps lying by omission about problems within the strata in their minutes. And when there isn't the kind of oversight and impartiality of a third-party property manager,
Yeah.
they can bury stuff that's wrong. And they got burned, so they just, okay, we'll cut that off. We won't do large self-managed stratas. So this is, I think, the only one really in Victoria where we've had trouble, over on Aldersmith, which is right behind the Canadian Tire and View Royal. Just watch them, large self-managed strata. Hopefully this rarely comes up.
Familiar with that one, just sold one in there.
Yeah, did you have any trouble with deals collapsing on financing? Or was it a cash buyer?
Yeah, we ended up with a cash buyer, of course.
Okay,
Yeah.
yeah, so anything that has a strata that provides more than just like your typical, I vacuum the hallways and I fix the garden. So this one has meal and linen services. Lenders just don't want them, not interested. This was a nice character house in Vic West. The problem was it had been gutted to the studs. Lenders want homes that are in what they describe as average or better condition and certainly livable. So anytime that you come across, your handyman who's looking to fix something up, if it starts off terrible, it can be very difficult to get a conventional mortgage to buy it. In this particular property, I remember talking with the agent, and they had a number of deals collapse on financing just because people didn't think that it would be an issue.
Hey, Nick, with these ones, a lot of them are like, the lenders don't like them. The lenders won't typically do standard mortgages. What about when the values, like, say on Garnett there, it's 300,000 for the unit, and someone's really only looking for like maybe a $50,000 mortgage where it's really low risk, and they're not really mortgaging the whole thing. Does that change things if it's a smaller borrow?
It can potentially open up some options. If there's a lender that has a hard and fast policy, we will not touch X type of property regardless, then no, it's not going to help.
Okay.
But it might help you get an exception with a lender who doesn't maybe have a firm policy on it. Yeah. Stormont, nice looking normal house in View Royal, commercially zoned. So watch the zoning. Lenders are wanting home properties that are going to be a house. They don't want businesses. They don't want weird stuff. Here's another one. This is a funny little street in James Bay, right by Fisherman's Wharf. M2 is industrial zoning. So you could have a warehouse.
So that's just zoning. Like if it's fully being used as residential, but it just happens to sit in an area that allows for other options, it could be a red flag, eh?
I'm not saying it's a hard stop, but I'm saying it's going to limit your lending, your pool of potential lenders. You know, if there's 50 lenders in Canada that do business, the fact that it's industrially zoned might cut 40 of them out of the lending pool. So this is more, agents should have this at the front of their mind. If they do go to show a property that has something with one of these red flag type issues going on with it, just mention it to your client. Say, hey, just so you know, before we go to see this, this could be an issue. Maybe talk to your financing guy and make sure that it's not, before we go too far down the rabbit hole. You know, you spent $600 on a building inspection only to find out that you can't get a mortgage. Well, that's not good for anybody. And you also as agents don't want to write offers that aren't going to ultimately come to fruition, because part of your reputation is delivering the subject removal, and it helps you are always getting it done. This is a condo, Oak Bay Junction, kind of Stadacona Park area. Decent looking building built in 1989. Massive special assessment, $140,000 per unit. And almost no lenders will touch anything with a pending special assessment. They don't want, for anyone who's ever undertaken a renovation, you never really know what it's going to cost until you've got your final bill. And lenders are no different. They don't want to take responsibility for the Pandora's box of problems that you might find when you start ripping the stucco off with a building to fix the rot and the mold. So big special
I wonder how many days on market. I wonder how many days on market that listing sat before that listing agent was like, okay, I'm so tired of these things collapsing. I'm just going to put this in the notes.
Yeah, well, exactly. Not really a surprise. Float homes are hard to finance. You are not mortgaging property. You're mortgaging a little floating box that also suffers from rapid deterioration compared to a regular structure. This one even actually had a note right in the M2M. TD Bank may finance. So in advance of, or as a result of multiple things falling apart, they did some homework on that, which is good. House in Esquimalt. Nothing otherwise wrong with it, except it's tiny. And anything that's really unusually small, often it will be below a lender's parameters for what they'll touch. 593 is getting close to as small of a detached house as you will be able to get financing for. And a lot of lenders require 800 or 900 square feet.
Now, what if that had 600 unfinished square feet basement that obviously is, you know, a buyer could expand that square footage? Would that be something that the lender would consider?
Yeah, that helps. Anything that makes it more, generally speaking, marketable is good.
Yeah.
But certainly there are a few lenders who would say, no, 593, we require 750. Don't even talk to us.
Yeah, especially if that's just sitting on a crawl space, like you're out of, that's it.
And that one is.
Yeah.
And it's on a small lot, so you can't make it any bigger, really.
Yeah.
35 by 58. Store Street downtown, again, tiny condo.
Wow.
The Janian building, it's extremely desirable. People love to buy them. They are very good Airbnbs. Very hard to mortgage. Property in Elk Lake. Nothing wrong with the house, but it's 20 acres. And a lot of the time lenders will just say, we'll lend on the house with 5 acres, the house with 10 acres. So it's not that you can't get a mortgage, but just that they will ignore the contributory value of some of that extra stuff. This is my lowest sale of my entire career. Quarter shares, any fractional ownership, it's anything that's in a rental pool, you're not getting a mortgage. This was $38,500. So it wasn't a big concern for the buyers. It was just the weekend place, but you're not getting a mortgage on the fractional ownership property anywhere.
So that would be one where you might just get a line of credit on your existing home and then take that cash and go and.
Yeah, well, for any of these, Jeff, if you've got another property that's more easily financed,
Yeah,
my advice, in absence of other information, be finance the other thing,
Yeah, finance
And-
yourself, right?
finance the other property that's desirable to lenders, and use the equity or the available funds from that to buy the weird one.
Okay.
Property on Salt Spring, it's made out of rammed earth. I've never actually had to come across one of these, but I do know that they are a nightmare to get a mortgage for. There aren't enough of them that it will probably ever be an issue, but basically they pack dirt to make the house.
Sorry, what's the deal with this one?
It's made out of the construction standard. It's rammed earth.
Okay.
This was one that I was actually involved in. I did the financing for this one. The only heat source for this house was a wood fireplace or a wood burning stove. The owner had removed all of the electric baseboard heat. And this is a weird one, but I don't think there is a lender who will allow a wood as the primary source of heat for a structure. So the workaround that we did for this was,
A condition the seller would put a few baseboard heaters in?
yeah, we made it a fundamental term of the contract that prior to completion, the seller would reinstall the electric baseboard heat. And no problem, got it done, but had to be worked around.
Yeah.
Interestingly, in this case, the seller had also spent the 20 years that they lived there burying all of their garbage on the property, which was only
Nice.
discovered after purchase.
Perfect.
And they had to come back and remove it all.
Did they? Now, how
they
did
did.
you get that done?
Well, I didn't, the agent did, basically legal threat.
Gotcha.
This was my listing. It was a tricky one to finance because it had an outstanding bylaw infraction notice with the city. So registered on title, there was a notification that there had been work done illegally. Most of the time when you do illegal work, nobody knows, but if you bring it to the city's attention, which is unfortunately what the seller of this property did, they put an art notification on title, and it was really, really, really hard for the buyer to get a mortgage to buy this thing. The other issue with this one, which is also weird, is that the house straddled two legal lots.
Mm,
And some lenders won't touch anything that has two legal lots because they think we're actually financing raw land. This is a development play, something like that. So we were able to dance around that by saying, look, the house sits in the middle of the lots. It's not really subdividable, or you can't do anything without taking the house down. But the bylaw infraction was an issue. They got through it though.
well, they sold it at the right time, didn't they?
Yeah. Yeah. Here's one that this is a pretty common one. You'll probably all encounter this. Vermiculite and oil tank issues. This is a really common one. Pretty much every house in Victoria that's more than about 30 years old has some kind of asbestos in it somewhere. If the property disclosure statement and the end-to-end notes talk about vermiculite or asbestos, lenders pick up on that. If it's encapsulated in an attic space that you never need to get to, usually it's not a big deal. It's always case by case. The underground oil storage tanks, so this one was on the neighboring lot. I think they're just covering themselves by disclosing that. But underground oil storage tanks are a hard stop pretty much for anything. Now, last one. This is a weird one, and it doesn't make a lot of sense. But Ben there may have some thoughts on this. Log construction. The cost of repairing rotten log structures can be prohibitive. And as a consequence, some lenders just will not finance them. So this thing was built of stacked wood. And I guess if the bottom timber rots, you got to take the house apart to fix it. I don't have expertise in this category, but some lenders, if it's log, they're not touching it. So that's kind of it for the hot list of property types. To just be cognizant of, if you are showing them, that there could be some extra hoops to jump through or a little bit of extra work to get financing, or it may just not be possible, just depending on exactly what the circumstance is. And I think it's to your benefit as an agent to not waste your time if your client has no reasonable means of getting money for them. And it also makes you look like a pro if you say, hey, just so you know in advance, please speak to your financing provider about this specific issue and make sure it won't be a concern, or that they have another option to finance it. So that's kind of what I wanted to briefly cover. Any questions or comments or thoughts on any of that?
You know, that's awesome because, oh, go ahead, Alice.
About the condos with special assessments. If the buyer is basically paying for it, does that get any favor with the lenders? Like, is that a way?
You mean if the seller?
The seller?
Okay.
Sorry, the sellers, yeah.
Not really, because the exact cost and the timeline for the building to be fixed isn't really known until they get into it. And they usually want to see like an engineer's certificate of completion prior to advancing funds. Now, with any of this, there's often a workaround, which is doing your financing in 2 steps, getting a private lending company, like an expensive, I won't say loan shark or retail company, but a more expensive equity-driven lender who will step in, they'll give you the money for 6 months or a year, you'll pay for it. And then once the thing's fixed or whatever the issue is that was problematic has been resolved, then you can go back and get a more conventional type financing structure. And in fact, if you've got a client who's willing to take the risk on the cost of a special assessment and has the resources to kind of ride the thing through for a year, you can get good deals on stuff like this. But it's not going to be a question of banging in your application at the bank and getting an approval 48 hours later and moving along your merry way. So.
Could I also ask, so you mentioned CMHC won't touch stratas with any age restrictions, like is there exceptions for that?
Nope.
No.
CMHC won't, but there are 2 private sector mortgage insurance providers. One is called they changed the name, Sagen Financial. One is called Canada Guarantee. And they offer almost identical third-party default insurance to what CMHC offers. From a consumer standpoint, it's indistinguishable. So there are typically ways to avoid the age discrimination issue. If I see it, what I'll do is I'll tell a lender, please don't use CMHC because of the age restriction. And it's not, it doesn't usually get in the way of getting a mortgage, but it just changes a little bit the approach that we have to take to make sure that we don't have a problem.
Okay. Cool.
Do you guys all understand exactly what CMHC's role is?
Go ahead and share for the new guys there.
So, and this sort of speaks to one of the things I had mentioned earlier about financing land. But so big picture, CMHC is a federal crown corporation. And in Canada, it used to be impossible to borrow more than 75% of the value of a house. There's a piece of legislation called the Bank Act, which is designed to prevent Canadian financial institutions from taking on undue risk in their lending practices. So if you imagine putting a down payment on a house and the market falls, and you're a lender that has financed, thousands and thousands of homes, and there's a terrible recession, people are losing their jobs and not making payments. If the lender then goes and forecloses on all of these homes, they could actually end up selling them for less than they're owed. And so the Bank Act, especially when if people had small down payments. So the Bank Act makes it, in fact, illegal for lenders to offer such mortgages. So the threshold was 75%. It was increased about 20 years ago to 80%, but it was not possible to borrow more than 80% of the property value unless the loan was protected with third-party mortgage default insurance. And that's what people commonly refer to as CMHC insurance. And we've got CMHC, Sagen, and Canada Guarantee are all insurance companies offering the same thing. So in a simple example, if you had a $500,000 mortgage on a $600,000 house, the housing market collapsed and the house is only worth $400,000, and the owners lost their jobs, couldn't afford their payments, and said to the bank, take the keys, sell this thing, we can't deal with it. The lender would come in, sell the thing at foreclosure, only receive $400,000. They would take that 400. They're owed 5. The insurance company, whoever it is, will pay them, the lender, that $100,000 loss that they would otherwise have suffered. So the purpose for it is to protect the financial industry nationally against calamitous default in the event of huge recession or economic collapse.
Does
So-
that lender have to like prove somehow that they made best efforts to sell at the highest price? Because obviously insurance companies are not going to be excited about the shortfall, so they're going to want to minimize the shortfall.
Yes, but basically that's achieved by listing it on MLS.
Gotcha. Okay.
So you won't have a foreclosure where they try and work out a side deal with,
Yeah.
their buddy to pick it up for pennies on the dollar. Won't happen.
And they all pretty much go to the court, which has the opportunity to get bid up and stuff. So, okay.
That's right. Yeah, I'm sure you can go on about the foreclosure process. So that's what CMHC or mortgage default insurance does. But because CMHC in particular is owned by the federal government, and in Canada, government is extraordinarily sensitive to any acts of discrimination. That's why CMHC in particular won't permit age restrictions. No. Their mandate is to provide equal access to housing for Canadians. However, as I'm sure you already know, anything over $1 million is considered a luxury property, to which CMHC has no mandate to provide access to luxury accommodations. So anything over $1 million, you need your 20% down, even though in Victoria, the benchmark single family price is like 115 or something like that. So the rules don't make a lot of sense when applied nationally when our prices are so high.
Okay. And Nick, for the new guys, can you just briefly explain how the lending process works when they're dealing with their buyers, maybe first time buyers, and kind of a soft approval, a hard approval, what you do when you receive the applications and how that kind of goes out?
Yeah, how much time have I got?
As long as you want, man. Like, I mean, just a brief summary,
Okay, so typically what I would recommend to agents, before you start taking your time and your resources and going out and showing people around, make sure that the buyers, potential buyers, are sat down and had someone do a proper evaluation of their borrowing capacity, so that you know what price range that you're looking in, and in general that they're in a position to actually act when they see the right property. It also will help the lending provider respond more quickly if the people already have their ducks in a row in terms of having provided their down payment documentation and their personal information to do credit reports, all of that stuff. So typically what I'll do, and I'm also happy on an individual basis to meet with any of you and go through the kind of same buyer explanation that I do with people. And I think it'll probably provide some insights to things that you haven't had things explained to you in that particular way. So I like to collect all of their information, run their credit, get their down payment documentation, get their income documentation, and basically work through the entire mortgage process with them so that they understand what their options are, how much they qualify for, why they qualify for that amount, what changes they could make to their personal financial circumstance to potentially increase their financing capacity. I'm working on a deal right now where a lady has a terrible credit score, and everything that she's ever done is perfect, except that she got a speeding ticket in Saskatchewan that she felt was unfair and refused to pay. So she's not a bad person. She's not a deadbeat and has lots of assets, but the Saskatchewan provincial government sent her to a collections agency for like $300, and it's killed her credit score. Now, fortunately, in this case, she's not buying the property tomorrow. She's on like a 6-month timeline. So it gives us the ability to say, hey, I understand that you don't feel that this is fair. It doesn't really matter unless you're going to go to court to try and dispute it, which you're not going to fly to Saskatchewan to do. Just pay it, get it done, get the paperwork, and get this collection removed from your record. With the luxury of a bit of time, you can do that. If you write up an offer and then have this person, show up at someone's death and get a mortgage, it's too late. And in this case, like the preventative credit strategizing will enable that person's agent to actually get a deal done. And for the client not to lose out on their dream house once they find it, all that good stuff too. So the earlier on in the process you can get the person in front of someone who can talk to them about this stuff, the better. And there are things like identifying, is there any money coming from out of the country that's going to be part of this transaction? I had a guy recently moved here from Hawaii. Nothing wrong with the deal, except that as much as you have to fin track people, financial institutions have to fin track where money comes from. And any money that comes from out of the country is put into a different risk category than money that was already on deposit with Canadian institution. So by talking to that guy in advance, I was able to say, look, get your money here as quickly as you can from your house sale, because we need it to be here 30 days prior to your transaction completing. And he did. He had 35 days between the sale and the purchase, but by doing it right away, we just were able to make it not be a problem. So I feel like I'm a little bit rambling here, but basically, the earlier on in the process you can start the mortgage conversation, the better served your client will be. And I think the more efficiently your time will be allocated to showing them properties that they can afford and will work. Yeah.
And when you get an application, do you kind of look at the property type and do you decide like where you're going to take it, or do you put it out there to multiples and see who comes back to you, or how does that work?
No, so basically what we do, once there's an accepted offer in place and it's somebody that we've been working with and already have most of the information on, we have to get a new pay stub or update something, but we already know the facts. What we'll do is identify with them, here are your options. We know, like my job is to know what lenders will approve. And so it's part of the reason I'm able to get things done is that the lenders that I work with realize that if they approve a deal for me, there's a 99% chance that deal is actually going to come together. So I don't shotgun applications to 6 different lenders and have 5 of them waste their time. That really burns my political capital with them. So I like to discuss with the client, here are the options, here are the pros and cons of these options, which path would you like to take? And then once they've made that kind of decision, I can't tell people what to do. I can just give them their viable options. Then we only go with the lender that we know is going to get it done.
And you know who has what rates, and so
Oh,
you're
yeah.
going to always go with kind of the best mortgage that you think will be approved, basically.
Exactly. So there's like a universe of lenders that's this big. The universe that might approve this particular deal is this big. So we have to work from within these constraints. And then what is the best product for this borrower? Taking into consideration, not just rate, but also capacity to make extra payments, penalty provisions down the road. Is there the flexibility of having a credit line? Is there some tax strategy involved? Like if they're purchasing an investment property, do they later want to plan to turn this one into a rental? Like the more of a big picture understanding we can have of how this property and this mortgage are going to fit into their big picture life plans, just the better guidance we can offer. Ultimately, our job is to educate and let people make the best decision for themselves.
And are there different products that you as a broker make better commissions on, where there could be conflict, where there are shady lenders or not shady brokers who essentially kind of ignore certain lenders because they will make more off getting you over to this guy or any of that? Does that kind of stuff happen in that industry?
Maybe it does to a degree. I would say that the compensation from lender to lender is fairly consistent. In the same way that realtors are obligated to provide the disclosure of remuneration, mortgage brokers are obligated to provide something called a Form 10, which describes exactly what you're being compensated. Any additional, travel points, any of that stuff has to be on there, referral fees. So it used to be fairly opaque into the consumer, but now it's entirely transparent, which is a good thing. I would say that the variation, though, from one lender to the next is really inconsequential. Certainly, from my perspective, it has 0 impact. I think what is the best solution for this platform? Period. Compensation is what it is.
Yeah, and a better rate for the client's more likely to turn into an actual deal.
I would rather, and I'm sure Jeff will attest to this in his career as well. I would rather have a happy client than make an extra $1,000.
Yeah.
And if you do that consistently from every opportunity that's presented to you, and always just, if your default moral compass is what is the best thing for my client, period, you're going to be a success in the industry and you'll have happy clients who trust you. And burning that trust and destroying your reputation not worth it. I think it happens honestly more in big cities, Toronto, Vancouver, where you can be a little bit more anonymous. Vancouver Island is such a small place,
Yeah,
and you run into the same agents time and time again. Everybody knows everybody.
yeah, we all know the agents that would take the $1,000, you know? So, yeah, and hey, are you allowed to represent a real estate client in a mortgage transaction? Are you allowed to double dip?
I'm allowed to represent a purchaser and arrange financing for that person. I will not, I think technically I'm allowed to, but I don't view it as being prudent. And I've had people ask me to do this before, and I've had to decline. If it's my listing, I will not represent someone trying to get mortgage financing.
Yeah, that makes sense.
I just pass that one along. If it's a buyer trying to purchase a property with me and have me do the financing, I have to disclose all of that.
Yeah.
And I do. And I would say that happens probably with 10% of my clients.
Really, that's it, eh?
Yeah. Yeah, like it's people who come to me for mortgages come to me for mortgages. People who come to me for real estate come to me for real estate. And you know, I don't try to mix it up too much, because like if Jeff sends me a client, that's just real estate client forever, you know, and like a lot of my mortgage clients do.
Well, that's not true, you see, because Ben was my real estate client and he's no longer a client of mine. So it's not always the case, you know.
Well,
now
Jeff,
Ben is your client still.
I think you have to look in the mirror a little bit at the responsibility for that.
Right on, Nick. Well, that's great. Unless anyone has any questions, we can let you get on with your day.
Yeah, I just had one thought. You're remunerated from the actual lenders themselves, right, Nick?
Oh, yeah. So 95% of the time, mortgage brokers are paid by the lender at completion for arranging the financing. If it's something unusual like construction financing, private lending, or something kind of on the alternative space, then that's not necessarily the case. But
Yeah.
with you know your Scotiabanks and your kind of major lenders, then yeah, absolutely.
Because I think that with our transactions, that like our correspondence in the past, there was one alternative lender, I guess, that you said if we do go with this one, if there's a reason that we can go with this one, you'd be remunerated directly from the buyer, but you're just really transparent about it, and there's a specific strategy behind that or a reason behind that, right?
Yeah, exactly. So there are lenders who do not typically work with mortgage brokers. For whatever reason, their business model doesn't do that. As an example, CIBC, Royal Bank, and a number of the sort of weird small credit unions. And sometimes one of those lenders will have a really, really appropriate solution for a person's financial circumstance. Their policies change all the time as well. Whether the value that maybe some of those lenders can provide has decreased. But here's a good example. We had a client recently in Toronto who bought unconditionally a house that would be like one of the examples that I provided there, where it wasn't gutted, but it had no kitchen and no floors and half the walls were gone. It did have a working bathroom, but it was not livable. And she bought the thing unconditionally about 8 months ago during the peak of the market, multiple offer bidding war, over asking, and bought this thing. And then went to her mortgage broker back east, who said, well, the only solution we have is this private financing who will allow you to get in, finish all of this work, and then you can move on. And they were quoting her something like 12% interest with a 2% fee to the lender and a 2% fee to the broker. So she needed $1 million, so $40,000 in fees plus 12% interest. So $4,000 a month in interest cost. No, sorry, $10,000 a month in interest cost. And I was able to take it to someone I know at CIBC. CIBC is the only lender who will let you do a crazy amount of improvements under a purchase with basically no dollar limit. Most lenders, if you need to do 30, 40 grand worth of work, they'll finance that. But that's like, changing the roof, new kitchen cabinets, that kind of stuff. But this was like a full reno. So we got her approved through CIBC at a really, really competitive rate. and charged her a 1% fee. So just even on the fee side, she went from 4% to 1%. And then on the rate, she went from 12 to like 3.5 or something. I forget the specifics, but she saved like in the first year in excess of $50,000 in costs. So she was delighted to pay the $10,000, you know? And it was like the one magic bullet solution for that weird circumstance that she found herself in. So yeah, sometimes there are fees, but it's only if the overall picture is better for the client.
Thanks for that.
Yeah.
Cool. So guys, Nick is one of many brokers we have in Victoria. But I like Nick. I chose Nick to come on here because he's legit, he's sincere, he answers his phone. You can trust him with your clients. Like, he's one of those guys that you can just count on. And he also has access and resources to very unique lending opportunities. In fact, he'll even, you know, potentially finance something personally if the situation arises that makes sense for him. So if you ever have a client that's kind of in a sticky situation and you kind of need a backup plan, Nick's usually a good go-to for those situations.
Yeah.
I worked with you personally, Nick, and we really appreciated it. I can personally attest to that. And then I obviously recommended my parents as well. So you're great. And you're like the softest hard money lender in the city, right?
You don't want to get on my bad side, buddy. No. Yeah, well, I appreciate that. And as I said, for any of you who would like to kind of go through the whole process, even if it's just even for your own knowledge or for your own personal plans to buy a property, happy to do that at any time. Sit down, buy lunch, whatever. And think of me as a resource that you can phone, even if I'm not doing the mortgage situation for one of your clients and you think things are not making sense. I'm happy to give you a second opinion, whatever it takes. We're all here to get the same thing done, right? Get the deal done. And yeah, I'm here for that. So
Awesome. Thanks for coming on, brother.
thanks. Always a pleasure, and appreciate the invite.
Absolutely. We'll talk to you soon. Maybe we'll have you on again in the future with maybe some interest rate updates or anything like that. I guess quickly, where do you think things are headed in the next 6 months? I mean, we don't have a crystal ball, but we all, depending on your political mindset, we all have different ideas of where we could see things end up here.
Yeah, really good question. You're right. Don't have a crystal ball. I'll tell you a few things. My personal mortgage is variable, and I'm leaving it on variable. I feel that there has been an overreaction by the central banks to inflationary concerns. I think part of the inflation that they measured is in comparison to unusual years due to the pandemic. So certain things weren't being consumed to the extent they would, and the production of a lot of goods was just not what it historically could be. A friend of mine runs a door manufacturing company. They have 5 plants around North America, Mexico, and Canada. And they have never had, well, now they do, but during the pandemic, they never had more than 3 plants running at once. So they kept upping the price of their doors to stop people from buying. And because during the pandemic, home construction and renovation went nuts, it had no effect. So they kept increasing their prices and increasing their prices, and the orders kept coming in. So I think that the pendulum has swung too far. I think the federal government or the central banks have put too much restriction on economic growth. And my personal gut is that we're going to see things peak in the next 2 to 3 months, plateau for a little while, and then fall back down as the economy starts to slow down. We've already seen it dramatically in the housing sector all across the country. If you follow commodity futures prices like lumber, they're down hugely, like 60%, the cost of just 2x4s. And I feel like as those costs are reduced for companies that are making stuff, eventually the cost of stuff to consumers has to decrease as well, which negates inflation, and hopefully we come to a new normal. I think a good strategy right now is a 1 or a 2 year fixed term.
Yeah, I agree. I like that. Awesome.
Yeah.
Thanks, man.
Good. Thanks all. Take care.
Take it easy, pal.
Bye for now.
Bye-bye.